The market's changing, not crashing, not collapsing, but changing. And if you're a buyer right now, you need to understand exactly what's happening so you don't misread it. Because the worst thing you can do in a shifting market is make a decision based on last year's conditions. Here's what's actually going on. Clearance rates in Sydney are sitting around 50%. In a normal market, that number's sort of 65, 66%. And when things are flying, it's probably closer to 80%. So 50 is a real signal. That's not noise. That's the market telling you something is wrong. What it's telling you is that demand has hit some headwinds. Higher rates, tighter serviceability, confidence wavering. Whatever the reason, buyers are pulling back, and that's showing up in the numbers. Now here's the part most people get wrong. When buyers hear clearance rates are falling, they assume stock is disappearing. Vendors are pulling out. There's nothing to buy. Actually, the opposite is happening. Stock levels are rising, not because vendors are flooding in, but because the properties already on the market are sitting there longer. They're not being absorbed, so total inventory is creeping up, and that's giving buyers something they haven't had in a while. Time, choice, and leverage. But, and this matters, it's not uniform across the market. In Sydney, the upper quartile starts around 2.3 million. That's where most of the downward pressure is concentrated right now. That's where buyers are finding it hardest to get credit, hardest to service their debt, and hardest to find competition that drives prices up. The lower quartile, anything under 1.2 million, it's a completely different story. That's where demand is stacking up. First home buyers with government guarantee schemes, investors chasing yield, upsizers who have been priced out of the next bracket and are recalibrating, all competing for the same pool of affordable stock. So when someone says the market is soft, ask them which market? Because right now the answer depends heavily on what you're buying and at what price. I've watched this play out across a lot of transactions. The buyers who get hurt in a shifting market aren't the ones who wait, it's the ones who act on the wrong read. They hear prices are falling and they think everything is on sale. They go hunting in the sub $1.2 million range thinking they'll pick up a bargain, and they find they're still competing hard because that segment hasn't softened. Or they're at the $2 to $3 million mark, they see clearance rates drop and they panic out of the market entirely. When actually, for a patient buyer with their finances sorted, this is the moment where you can negotiate, where vendors who've sat on the market for 6 weeks will start to talk. The move right now, if you're a buyer, is this. Get your finance sorted first. Know your actual number, not the one you're hoping for. With rates where they are, your borrowing capacity is probably less than you think. And if you go into the market with the wrong number in your head, the market will teach you the hard way. Then focus your search where supply and demand actually favor you. If you're buying above 2 million in Sydney, you've got more runway than you've had in years. Use it, don't rush. If you're buying at the affordable end, don't assume softening conditions apply there. They largely don't. You still need to move when the right property comes up. The market shifts, the fundamentals don't. Buy the right property in the right location at the right price and where the cycle sits. That's the play. And it doesn't change. If you want to talk through where you're at and what this means for your specific search, the link below books a free call. There's no pitch, no pressure, just a conversation about your situation and how we can help.